Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Thursday, April 1st, 2010. Let's begin today's broadcast by looking at some manufacturing data from around the world. We had some strong rates of expansion in manufacturing, which is providing some evidence that a global economic recovery is progressing, which raises the prospects that central banks may tighten monetary policy. In the UK, the manufacturing PMI for the month of March rose to 57.2, which was a 15-year high, as we have increased demand from Asia, as well as a lower UK pound is helping to make UK exports more competitive abroad. In the Eurozone, meanwhile, the final version of manufacturing PMI ticked up to 56.6 from the preliminary reading of 56.3 and from February's 54.2. That was a 40-month high for the index, or going back to November of '06, and we had some similar factors in that a weakened euro combined with a rising global demand helped to boost export growth to a 10-year high throughout the Eurozone. Also overnight, we saw that the Chinese manufacturing PMI rose to 55.1 from 52 in February. So those numbers had helped to drive an across-the-board rally in global equities, commodities, and non-dollar currency. In the US, meanwhile, the ISM manufacturing PMI for the month of March jumped to 59.6, higher than the expected 57, and about 3 points higher than we were in February. New orders and production both were above the 60 level. While employment did tick down to 55.1, it was still pretty strong above the 50 level. Overall, this factory report from the US was the best month of activity in nearly 6 years. We also had the inventories index move above the 50 level for the first time in 46 months, which is perhaps a signal that manufacturers are willing to increase inventories based on expected levels of activity. This piece of data too helped to boost US equities, and we had a pretty strong risk appetite as a result. So let's see how this data had affected our main currency pairs. First, let's start with the pound dollar, where we saw the pound rising above the 1.52 level, an important level of resistance. And following the US release of its positive manufacturing index, we pushed above the 1.5250 level, testing 1.5280. Now the 1.52 level had acted as important level of resistance throughout most of March, and now we move above it and look to test this 1.5370 high that we saw on March 18th. Today's rally extends the gains we had seen for this pair the last 5 sessions after we found support around 1.48. The dollar-yen pair rose in favor of the greenback, pushing above the 93.65 high we had from yesterday, reaching the 94 level around 11:40 a.m. Eastern. In a look at a daily chart, we see that today's move pushed us above our 2010 high that happened around early January, and we are at our highest level since late August. The yen is being swept lower by outflows as Japanese investors take fresh positions abroad at the start of a new fiscal year. With the positive news, U.S. Treasuries were also down, which meant that yields were up, as the markets see today's data increasing the chance of higher interest rates. So interest rate differentials are now favoring the dollar against the yen, and we have seen that story break in last week's trading around Wednesday, when we had a rise in yields in the U.S. as well. So we'll see how this new leg of a U.S. rally in this pair continues as we push above our old resistance and look to 97.50 as our new resistance. We had a second report from the U.S. that showed that jobless claims fell to 439,000 for the week ending March 27th. That brought the 4-week moving average of jobless claims down to its lowest level since 2008 as the economic recovery prompted companies to retain staff. This bolsters expectations that claims appear to be back on a clear downtrend as the labor market slowly heals. So we had started that downtrend earlier in the year, in April 2009, and we had a bit of a pause in February, but now we seem to be moving downward yet again. Now tomorrow we will get the U.S. non-farm payroll report for March, and while the consensus was for a rise of as much as 200,000 jobs last month, after a fall of 30,000 in February, there are some fears that the number could come in lower after we had a weaker than expected ADP employment survey on Wednesday. That showed that private sector jobs fell by 23,000 during March instead of the 40,000 which had been expected. So a strong payroll figure would help increase expectations of an earlier hike in U.S. interest rates, while a disappointing payroll figure may lower those expectations. With the positive mood coming from our different manufacturing data releases around the world, we definitely had a risk-on feeling to today's trading, and growth-linked currencies such as the Canadian dollar and Australian dollar were big benefactors. So today, the Canadian dollar extended its gains against the U.S. dollar, and we had the U.S. dollar-Canadian dollar pair drop below the 1.01 level in New York trading. As of noon New York time, the Dow Jones Index was looking to test the 11,000 level, and oil prices were just below $85 a barrel, so that was about a 1.4% increase on the day. So that helped the Canadian dollar to extend these gains, and we could see that it continues to do so around noon New York time. We now reach our support from around March 17th and March 21st, so we'll see if there's any bounce from that level, or if we just continue the downtrend started after we had tested the 1.03 level. The Australian dollar, following a decline in yesterday's trading, rebounded today, especially in New York session, as we moved back above the 92 level and now test our resistance for the week at 92.15. If we move above here, our next level of clear horizontal resistance will be the 0.9250 area. The sense of risk appetite and higher commodity prices helped to boost the price of gold as we move from the 1,117 level prior to the US Open, and we broke above that level, pushing all the way to 1,127. So that tests our levels from mid-March. And it does wipe out these losses that gold had suffered in late March, as we had the concerns over Greece. Before we wrap up today's broadcast, let's take a look at our euro-dollar pair. In today's trading, we had seen a decline. Overnight after testing 135.50, as we did have some continued concerns over the Greece debt situation, as the yield on 10-year Greek government bonds has increased 25 basis points since EU leaders agreed to an aid blueprint on March 25th. So that the yield on 10-year Greek bonds reached a one-month high of 6.529% yesterday. As borrowing costs increase for Greece, the risk is that EU leaders will have to deploy some kind of rescue mechanism that still needs to be fleshed out. However, with U.S. equities jumping and the risk appetite in the air, the euro did manage to pair these overnight losses after testing 134.50 and its moving average, and as of 12 noon has set a new high just at 135.63. So our bounce off support here at 135.50 is a positive sign, as that was our support during our consolidation zone throughout most of February and March, with our support at 134.50 and resistance at 1.38. So today we bounced up off that important power line, and now we test the second power line around 1.3550, which was our support back here, but had turned to resistance in around March 21st. So we'll see if the risk appetite gives this pair any momentum to push above this level, though again, the concerns over Greece and even Portugal and Spain still weigh on the euro. There will be no important releases overnight from either New Zealand or Australia or in the Eurozone countries, as both will be celebrating the Good Friday holiday, and banks and stock markets will be closed. While the U.S. stock market will also be closed for Good Friday, in tomorrow's North American session, we still will get March's non-farm payroll release. So as many traders won't be in front of their desks when the release comes out, the impact of the release may be stretched out for a couple of days, as Monday is also a holiday in most European countries. And that will do it for today's broadcast. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish everyone out there happy holidays.